Bring in show music, please.
Hi, I'm CNBC producer Katie Kramer. Today on Squawk Pod, the wealth tax that won't quit, how anti-billionaire sentiment and policy is impacting our politics. Former Senators Heidi Heitkamp.
This is not a new idea. This is called a personal property tax.
And Pat Toomey.
The exodus will be profound, and these are the folks that pay the lion's share of the revenue to California. This is a disaster in the making if they proceed with this.
Dry January is here. We check in with the CEO of non-alcoholic beer company Athletic Brewing.
Over 53% of Americans perceive drinking 1 to 2 drinks a day as unhealthy, which is up, I think, 14 points in 2 years.
I think it's a status thing to actually show this is non-alcoholic. Rather than pour it in a glass, you're maybe showing off. I'm drinking, but I'm not.
Plus, new year, new boss. The first day for a new CEO at Berkshire Hathaway. And New York swears in Mayor Zohran Mamdani.
This will be one of the most fascinating political stories to watch this year.
It's Friday, January 2nd, 2026. A new year of Squawk Pod begins right now.
Stand Becky by in 3, 2, 1. Cue it, please.
Good morning, everybody. Welcome to Squawk Box right here on CNBC. We are live from the NASDAQ market site in Times Square. I'm Becky Quick along with Mike Santoli and Robert Frank. Joe and Andrew are off today. Markets are not, though. If you check out what's happening with the U.S. equity futures, we are looking at some pretty decent-sized gains already on January 2nd. It looks like the Dow futures right now are indicated up by just over 200 points. S&P futures indicated up by about 44. The NASDAQ indicated up by close to 290 points. Of course, this comes after 4 down sessions in a row to end 2025. But that doesn't mean that the markets didn't end with a bit of a bang anyway. We were looking at pretty decent-sized returns. The NASDAQ composite, or the NASDAQ 100, was up by about 20%. You saw very sharp gains for both the Dow and the S&P 500. S&P 500 was up by about 16.4%, and then the Dow closed up by just under 13% for the year. The 3 major averages and the Russell 2000s all had their 6 positive year out of the last 7. Dow was up by 13%, the S&P about 16.4%, the NASDAQ more than 20%, and then the small cap Russell 2000 up by about 11.3%. Though with Wednesday's market decline in December, the S&P 500 broke a 7-month winning streak. So the best sector for the year last year, it was communication services. That sector up by more than 32%. It was the only sector to end the year lower, though, was real estate. That was just barely negative. And then the commodities markets, gold and silver, they've been one of the big market stories this week. Gold actually ended the year up more than 64%. Silver was up by 141%, both of them logging their best years since 1979. Same story for platinum with that. And by the way, both gold and silver are up once again this morning. In the meantime, the dollar was down by 9.4% last year. It was its worst year since 2017. WTI crude oil was down by 20% for 2020, so the worst year it's seen in several years, too. And then Bitcoin and Ether down by 6.7% and 11.3%, respectively. It was the first negative year for each of those cryptocurrencies since 2022. How would you guys wrap this up? How would you look back at the year and say, here's what we think?
Third straight year of double digit. I mean, the S&P 500 had been up 20% each of the prior 2 calendar years. So this is a pretty expansive 3-year bull market, most of it supported by earnings growth. So it wasn't really all about specific AI exuberance dominating. I mean, obviously that was a big part of the story. I think what's interesting about the way the stock market finished is that we've kind of gone sideways for 2 months. So most of those gains came in that huge 6-month sprint off the April lows, the tariff panic low. Yeah. S&P closed the year basically where it had been in late October, but within that period, you started to see outperformance by financial stocks, by transportation stocks, cyclicals, economically sensitive stuff. So the market seems to be positioning for a better economic pace in the early part of this year, even as tech had some profit taking that was an undertow.
Yeah, I was looking at when was the last time that we had 3 years of double-digit gains, and then what happened after that. So, Mike, I know you know this. It was the late 90s, .com, but then it wasn't that long ago, 2009 to 2021. Yeah. And then we had, of course, the decline in 2022 because of the interest rate increase. But it didn't really tell us much about the likelihood or unlikelihood that this year is going to be down just because we've had 3 years of double-digit gains.
No,
but
it doesn't.
is unusual.
Trends are persistent. Yeah.
We did have Sam Stovall on Wednesday, and he was talking a little bit about how rare it is to have 4 years in a row of big gains.
That is true. Exactly. Usually things moderate. I mean, look, you start off every year with the kind of the odds in the bull's favor, right? 70% of all calendar years are up.
Yeah.
So therefore, if everyone's talking about, well, if the first week is up, the whole year is going to be all that kind of stuff. Well, the more you stack the high probability outcomes, together, the more it seems like a lock. But it's never a lock. So, and usually, even if it's strong, you're going to have scares along the way.
Do you see over time a real seasonal effect of January optimism?
There's January flows, there's January optimism. A lot of professionals start with a blank slate, and all of a sudden they can kind of add to their risk budget.
Right.
But I don't think it's been very precise in terms of handicapping what happens based on. I mean, I know there are all these ways to slice and dice. Look, the Santa Claus rally period, right? We're down 1% over that. Yeah. We have 2 more trading days for it. I don't pay attention to it because it's basically become just noise. It's become this irrelevancy. It was down the last 2 years, and guess what? We were up the subsequent 12 months.
Do you pay attention to the January?
I mean, I pay attention to the general tenor of the market to start the year. What you often have seen in January historically is what didn't do well last year gets some relief, and what did do well last year gets some profit taking. It's obvious to try to sell into a new tax year if you just have appreciated stock. However, the market tries to front run that because that's what we were seeing last week. So it's very tough to tease out. The one indicator that I think is really worth watching, and it's one that doesn't trigger very often, is if in the first quarter you break December's low, that often is a sign of potential difficulty to come.
And that didn't count for last year because it was April. It was the second quarter before we had the
look,
really
I think. I guess you could say, but also like what happened in April is the kind of trouble you're trying to see if it's on the way. It's not to say that the whole year is going to be a washout, just that the market is on less firm footing.
I'll throw one more thing that I kind of watch in there, and that's the Davos indicator. Often how the beginning of the year starts is not what happens in Davos, and then Davos is often a counter indicator to what happens to the rest of the year.
Well, and there's also the big swing factor this year, which is policy, right? And so last year, everyone was optimistic about deregulation and tax cuts, right? What we didn't really see, certainly until well after the inauguration, was the tariff piece of it, and that came in April. So there could be a lot of surprises. What I also think is interesting is last year it said that communications was the top sector.
Yeah.
The AI trade is really the determinant factor for 2026.
Well, by the way, that was basically Alphabet. In terms of the communication services sector.
I wondered.
So essentially, it was like
bucket?
up 60%, added trillions in value. So there's
a great note from J.P. Morgan over the weekend. 42 AI-related companies generated 65 to 75% of all S&P 500 earnings and profits. So that really, all the outlooks for this year from the Wall Street banks, it's just where you land on AI.
Yeah.
That's the determinant factor.
Yeah. We have some other news to tell you about, too. Big changes in Omaha, Nebraska this week, and the business community at large is taking note. Warren Buffett has officially stepped down as the CEO of Berkshire Hathaway, the company that he built over the last 60 years, and he's handing over the reins to Greg Abel. Buffett remains chairman, of course. That announcement from Buffett about this transition coming back in May at the company's annual meeting, it was a surprise not only to the shareholders, but to most of the board and to Abel himself. So, what changes for Buffett today? Listen to what he told us just a few days after that surprise announcement.
Everything will be the same. I will come in. I won't be up there speaking at the annual meeting, but I'll be in the director's section. Maybe you'll interview me at the halftime or something of the sort. Who knows? But Greg will be the decider. He can't imagine how much more he can get accomplished in a week than I can, or a month. I mean, he just, and at the same time, he's not a distorted individual. He likes to play ice hockey with his kids, and he lives what would look like a normal life. And my guess is that if the neighbors didn't know who he was, they wouldn't have any idea that on January 1st, he is going to be the decider on a company that employs close to 400,000 people, and it's got plans to be around 50 or 100 years from now. And who knows what will happen, but it has a better chance, I think, of being here 100 years from now than any company I can think of.
Abel is inheriting a Berkshire company with a huge stockpile of cash. It was over $381 billion as of the end of September. And after a year when the company gained just over 11% versus the S&P, which was up by almost 17%. Abel, of course, will run all of Berkshire, having the final say on both investments and holding companies. Buffett offering some high praise of his successor. Listen into that as well.
And Greg's operated more than I have when you get right down to it. I mean, he's gone over to England to run something. He went to, he came to Omaha one time to run a business for a few years, and there's no secret formula that only CEOs have or anything of the sort. So I'd rather have Greg handling my money than any of the top investment advisors or any of the top CEOs of the United States.
That is a huge endorsement.
It is a huge endorsement, but it's an endorsement we've made, and I am going to have him handling the money of and in effect, he knows business.
So does Warren Buffett, and in fact, he is going out, guys, after 60 years with probably the most impressive compound interest record of anybody in history. Berkshire shares, I think I saw a statistic the other day that said they could drop more than 99%, and they still would have outperformed the S&P 500 over his 60 years running Berkshire.
Absolutely. I mean, so it's going to be unrivaled forever. I think what's really fascinating is how the character or the sort of profile of the company might evolve under Greg Abel. I've always assumed it was going to be a lot less about, the invest in public shares of other companies, that portfolio manager type approach, even though it's going to be there, right? You have all these great investments. I just wonder on the operating side what that means and if it's going to be more centralized or how that really does break from here and how the market views. I mean, the underperformance this year, first of all, beat the average stock. It was up huge into May on the exact announcement. And it's very defensive.
It was up huge until he announced he was stepping down, but I don't think it has collapsed as some people thought it would at some point.
Not at all.
Without Buffett being there. And
That's
I think that's important too, that continuity.
Without it. It's almost like anybody who would have sold because of that
They're gone
did it, or is about to, is in the process of doing it. And I do think there are questions we were asking last week, like, for example, there's always been this advantage of the status element of selling to Warren Buffett and becoming a partner of Warren Buffett's if you do sell your company to Berkshire. Is that going to go away? Is it going to be maintained?
Yeah, and I think, Mike, you've said before, there aren't a lot, perhaps any other successful conglomerates that continue. And I think Abel is clearly one of the, if not the best operators, if you're going to try to do that. But whether that can be sustained, because the history of conglomerates in this country is not great. But you're right, that's essentially what it is, along with this huge cash pile of $380 billion.
It's not great in general, but the way Berkshire runs a conglomerate, they're not pretending that there are magical synergies among all these companies that offset. It's just saying, you tell me what you need to run the business and reinvest in the business. Send the cash back to us. We'll figure out what to do with the surplus.
And a company like NetJets benefits from the low cost of capital, which is across the portfolio one of the huge advantages they have in all their businesses, that low cost of capital.
I mean, it's always been about the float, the insurance companies generating the float and then taking and reinvesting back. And Warren Buffett has been very clear about the idea that Greg Abel is going to have the ability to manage all of that cash. You're right. I don't know if it'll be stuck into stocks the same way. But what they talked about at the last annual meeting in May was this idea that you might take a lot of that money and invest in infrastructure projects or something to do with Mid-American Energy or Berkshire Hathaway Energy, as it's now called, or any of these other things. There's a lot of big deals. But I'll tell you, Buffett even said at the time, I wish somebody offered me a $100 billion deal today. They don't want this cash sitting around. They would like to deploy it, would like to put it to work. Buffett's still going to be there as chairman, which gives Greg Abel a lot of protection and a lot of runway to run the company the way he sees fit. I think of it a little bit the way you had Doug McMillon come in at Walmart, where he had the backing of the Walton family. He did some things at the beginning that caught Wall Street off guard, reinvesting in things. The stock sold off, but the Walton family supported him, and look at what happened with the next 11 years, how Doug ran that company too.
That's a good analogy.
Yeah. Folks, by the way, a programming note for you. While Buffett has said that he is going quiet, the sound that you just heard from him is part of a new primetime special that we're putting together. We're bringing it to you here on CNBC on Tuesday, January 13th at 7 p.m. Eastern Time. In a series of never-before-seen interviews, we spoke to Warren about his philosophies on business, philanthropy, on life, and how his perspectives have changed over the decades. Buffett's three children, Susie, Howie, and Peter, also join us to discuss the monumental task that their dad has given them, which is to eventually give away his entire fortune. But it's an interview I don't think you want to miss.
I can't wait to watch that, because they are going to become instantly the, if not among the most important philanthropists in the country.
Yeah, agree.
And they've been trained for it.
They have. They've spent decades at this point running their own philosophy or their own philanthropies and figuring out what works and what doesn't.
Yeah.
And they're going to be working together, which is really interesting too.
And it will be New Yorkers who reform a long broken property tax system. New Yorkers who will create a new Department of Community Safety that will tackle the mental health crisis and let the police focus on the job they signed up to do. New Yorkers who will take on the bad landlords who mistreat their tenants and free small business owners from the shackles of bloated bureaucracy.
Zohran Mamdani vowing an agenda aimed at making New York more affordable for working people. In a speech following his swearing in as New York City's next mayor, Mamdani promoted some of the central themes of his campaign, including universal child care, free buses, more affordable rent.
We will answer to all New Yorkers, not to any billionaire or oligarch who thinks they can buy our democracy. We will govern without shame and insecurity, making no apology for what we believe. I was elected as a democratic socialist, and I will govern as a democratic socialist.
A lot of excitement there. Mamdani's inauguration of 40,000 people braving the cold, also featuring speeches by fellow Democratic socialists, Senator Bernie Sanders of Vermont, New York Representative Alexandria Ocasio-Cortez. And, you know, it'll be interesting to see. We've got the New York governor race this year. Interesting to see where and whether he can get the money for these programs, what he can actually do. Mayor, of course, does not have the ability to raise taxes in New York City. That has to be approved in Albany. Sure. But we saw Governor Hochul there right next to Mamdani, showing her position, at least with regard to some of his policies. This will be one of the most fascinating political stories to watch this year. He is just a mayor, but it is New York City, and he has galvanized a lot of energy in this party.
Yeah, I mean, that's the really interesting thing. I feel like Governor Hochul will be in a little bit of a pickle. She's the one who will have to do all the things that voters hate, which is raise taxes in order to allow him to continue the agenda that he has run on. If she doesn't do it, she's the one stopping his agenda and irritating everybody who supported it. If she does do it, she's the one who's going to be the one who raised taxes.
And look, we all know here at CNBC.
And so far, she's been saying she's not going to raise taxes.
Absolutely. She has given a little bit on the corporate side. Yeah. She may raise the corporate taxes. But that's going to cost New York. And we can sit around here and we know what it means when the wealthy leave, when companies leave. But look, we are in a very populist time when most Americans are really under pressure from inflation, and they see the asset prices for the asset wealthy continue to rise. So it goes without saying that taxing the wealthy is more popular than ever right now. We see what's happening in California. So there is a lot of pressure both within her party, but also, I think, among voters.
Hey, we just got higher salt ceiling passed.
$40,000.
But for the majority of voters, that's still material. I also feel like you're starting from a point where New York's never been a low tax venue, right? So it's not as if, oh my gosh, the identity of New York as a tax haven is going to go away. So I think all those things fit into the debate a little bit here. Meanwhile, the affordability stuff, he's talking about permitting rules and all the other stuff that is within the mayor's control. Who knows if it's really going to matter, to get more housing built. But at least rhetorically, you can sort of say, look what I'm doing over here that seems a little bit more private sector solution compatible.
I guess, but free buses, free daycare, like a lot of these things, you need money to pay for those things.
The daycare for sure is a very, very expensive and tough thing.
Proposition. Yeah. You need money to be able to do that. You need higher taxes for that, but then do the higher taxes work if you lose the highest, the wealthiest out there? So there are questions that come with it. I did like Bernie Sanders. You saw him clapping and sitting there, so different from the meme from, remember Joe Biden's inauguration? When
he's excited.
Bernie Sanders was the meme, sitting out there in the same coat, it looked like, that he was wearing from that with his mittens.
I would bet a lot that it's the same coat.
I would bet so too. It looks just like it. It looks just like it. Yeah. By the way, I can't criticize. I think I'm wearing the same coat from years ago too.
Cheese will be next.
Coming up on Squawk Pod, are billionaires really about to leave California in droves because of a new tax on the wealthiest? Former Republican Senator Pat Toomey joins us.
It's not going to be just billionaires. People are going to realize there's no limiting principle here. If you can confiscate the assets of a billionaire, why not someone who's worth $500 million or $100 million?
And former Democrat Senator Heidi Heitkamp.
I think there's a whole lot of ways to address income inequality, a whole lot of ways to address the perception, if not reality, that rich people are not being taxed, than to simply embrace a wealth tax.
We'll be right back. Welcome back. This is Squawk Pod from CNBC. Today with Becky Quick, Mike Santoli, and Robert Frank.
Zohran Mamdani vowing an agenda aimed at making New York more affordable for working people. In a speech following his swearing in as New York City's mayor, Mamdani promoted some of the central themes of his campaign, including universal child care, free buses, and more affordable rent.
We will answer to all New Yorkers, not to any billionaire or oligarch who thinks they can buy our democracy. We will govern without shame and insecurity, making no apology for what we believe. I was elected as a democratic socialist, and I will govern as a democratic socialist.
Mamdani's inauguration also featured speeches by fellow Democratic Socialist Senator Bernie Sanders of Vermont and New York Representative Alexandria Ocasio-Cortez.
And the big chant at that rally was tax the rich. That was the big chant. And speaking of that, we're going to go to a wealth proposal in California that has angered some of the state's richest and some in the startup community. One of the big questions around the proposed billionaire tax is valuation. So most of the 200 billionaires in California made their wealth in tech, usually a stake in a private or a public company. Tech companies, as we all know and have seen, are highly volatile. So let's say your stake in a tech company was worth $1 billion as of January 1st next year. You would owe $50 million tax. If that valuation falls, let's say, by half in a few months, you would still owe that $50 million tax. In other words, tough. The bill makes no mention of refunds or credits. Now, the issue is especially important given the volatility of tech stocks and valuation. Last year, the AI boom created 50 new billionaires, many of them in California. If AI valuations could decline, some of those AI billionaires will no longer be billionaires, but they'd still owe a tax on wealth that they no longer have. Now, the bill does make provisions for private companies or illiquid assets that allows them to pay over 5 years, but the amount that is owed actually doesn't change. And there are penalties of up to 20 to 40% of the amount owed for those who fail to pay. So a lot of people, I've talked to a lot of tax attorneys that are helping a lot of Californians either make plans or move out of California. The question will be, because this is retroactive to yesterday, that you have to prove you're no longer a tax resident as of January 1st, 2026. Did they get enough time? Will it sort of withstand the legal challenges that it will inevitably face? But there are a lot of billionaires in California and soon to be billionaires that are trying to leave, planning to leave, at least finding out what it takes to leave California.
Well, there were a flurry of announcements that went out. Peter Thiel making a point of saying that his new office in Miami is set up.
Right, Larry
David
Page.
Sachs said that he's got a new office that just opened in Austin, Texas. And I think Peter Thiel's signed that December signed the lease for their extension on that. And what was Larry Page's?
Larry Page, same thing. He's got a family office in Miami. His family office head is now spending a lot of time in Miami. Now, the question of residency isn't just did you leave or were you out of the state for more than 180 days. It has to do with your bank accounts, where your kids are in school, where your pet goes to the vet, where your dentist is. So unless you've shown a pattern of all those things being in Texas or Florida for the past year, and the California auditors are very tough, even tougher than New York, when it comes to forcing you to prove that you have actually left. So that's going to be a question, along with, can you actually will the tax itself survive legal claims, but can you make a tax retroactive? That's going to be another big question.
Yeah. All right, joining us right now for more on the wealth tax debate is Heidi Heitkamp. She is former Democratic Senator of North Dakota, also a CNBC contributor, and Pat Toomey, who is former Republican Senator of Pennsylvania. And welcome to both of you. Senator Toomey, why don't we give you first dibs at this, because I want to get into Heidi's more nuanced view of some of these things. But what's your takeaway on whether a tax like this is A, legal, and B, effective?
Well, so the bottom line is I think this is a remarkably bad idea from a state that is quite generous in providing us with bad ideas. First and foremost is the principle here. We are not anywhere in this country, to my knowledge, have we established the principle that the government is going to confiscate part of your assets to give them away to people to whom they don't belong. This is something new and different. We definitely take income. We take a disproportionately high share of the income from upper income people, certainly relative to their share of earnings. And that's because we have an extremely progressive tax system. It's one of the most progressive in the entire OECD. But this would be a whole new idea that we're going to just confiscate part of your assets after, in most cases, people have paid income taxes on whatever it is that allowed them to accumulate these savings. A couple of other points I would make about this particular proposal. First of all, it's a lot of false advertising when they suggest this is going to be a one-time hit. That's the way it's drafted, but it also stipulates in the proposal that any revenue from this new tax has to go to expanding healthcare, and that means Medicaid as a practical matter. As we've seen, including very recently with respect to Obamacare, anytime you expand an entitlement, the left intends that expansion is permanent. And when the funding runs out and the spending continues, they're coming back for more. And when the exodus of billionaires, it's not going to be just billionaires. People are going to realize there's no limiting principle here. If you can confiscate the assets of a billionaire, why not someone who's worth 500 million or 100 million? And so the exodus will be profound. And these are the folks that pay the lion's share of the revenue to California. This is a disaster in the making if they proceed with this.
Senator Heitkamp, I'd ask you to defend the principle here and take the other side of that argument, but I don't think you want to.
Well, I've long said you can't really be successful in taxing unrealized capital gains. I will disagree with Pat on one thing. He says this is a new idea. This is not a new idea. This is called a personal property tax. And this personal property tax has been tried and failed in many, many states. It's been tried in a lot of other places across the world, and they've had to put the car in reverse and say it didn't work. And so let's also recognize that this is an initiative. They're going to need to get a lot of signatures. The governor of California has already suggested that he doesn't agree with this. I think some of this is an overreaction, but of course, when you're looking at an effective date of this retroactively, I think that causes a lot of concern when people look at it. But, the bottom line is that this is intrusive. This is not consistent with what we would call a taxable event. And Becky, as you know, also on my resume is I used to be a tax commissioner. Right. I used to do this for a living, and these are very, very hard to administer. And I think the left has gotten this idea that we don't really need to dig into the tax code to find those loopholes. What we really should do is just do another whole new tax. And I think there's a whole lot of ways to address income inequality, a whole lot of ways to address this in the perception, if not reality, that rich people are not being taxed than to simply embrace a wealth tax. I don't think it will work. I don't think it's going to pass. And I agree with Pat on one thing, that people, when they go to the polls, they say a billionaire today, it's me tomorrow.
Right. So because I don't think either of you is going to defend this in any way, shape, or form or say you're in favor of it, maybe we should turn this into a little bit of a broader conversation about the inequity that's out there right now that has been growing since Occupy Wall Street all the way back in the financial crisis period, what we see in terms of populism at this point and how you address that and how you get at it. It's certainly been exacerbated by the massive inflation that came around post-COVID or during COVID and then beyond that, what we've seen. That still impacts people and it's hitting them in lots of different ways. Pat, how would you get at trying to handle that and deal with it and maybe get at some of that inequality?
Yeah, Becky, I think a couple of things. One, I think we should keep in mind monetary policy can drive a lot of this, and excessively easy money help to drive up financial asset values in ways that are very beneficial for people who have financial assets. Lower income people tend not to have financial assets, so that's kind of unfair. But the most important thing, in my view, is two things. One, strong economic growth. Strong economic growth does lift almost all boats. We have seen that when the economy is growing strong, including right after the 2017 tax reform, for instance, real wages were rising, and they were rising fastest for lower income workers. That is the definition of narrowing the income gap. And then the last thing that's really, really important is that we have fluidity and mobility within income categories. So people who are born into the lowest category of, say, the lowest quadrant of earners, it's really important that we be in a society where that person has a realistic chance to move up. That has historically been the case. It's not as robust as I'd like to see it, but that's what I would focus on: economic growth and income mobility.
And Heidi, I just want to go back to Becky's point and follow up on that, because I think one of the challenges for voters here, when they look at someone like Larry Ellison, Sergey Brin, Larry Page, those are three of the top 5 wealthiest Americans, and they all live in California, is that basically all of them can live not tax-free income, but certainly use their shares. Larry Ellison owns 42% of Oracle, but he hasn't sold shares and doesn't need to because he can just borrow off those shares and use that income. How do you get at all of that wealth that for these folks will, some would say, never get taxed, especially if it goes to charity or is passed down through a trust to their children? Is there some way to tax that, or at least make sure that some of that income they get from borrowing against their shares faces some kind of maybe a capital gains tax? Or is there another way around that?
I think the first thing you need to address is stepped up basis. And so
Yes.
If my kids inherit my stock, they inherit Apple at a much lower basis than the fair market value. And that is a wealth multiplier, and it has created huge consequences, whether it is donations to charity or whether it is transfer at wealth, and so I think there's a lot of things you could talk about.
That has to be national policy.
Right. Right. But if you look at California has the ability to basically tax at death, and they can determine what the basis of that tax is. And so when you look at borrowing against those assets, that has been kind of the trick to avoid any kind of capital gains. And that needs to be addressed in terms of a tax loophole, along with carried interest and stepped up basis. And so there's a lot of things that you could do if you really understood how the tax code worked. Instead of knee-jerking, we're going to impose a wealth tax and that's going to solve the problem. It won't solve the problem long term. And so do we need to have an absolute discussion? And, Pat, one of the things I would say is, yes, for the first Trump term, you saw the lower quartile, the lower third, wages raise. That's not been true into this, this tranche of of the Trump administration. In fact, the lower quadrant has actually seen less growth than the middle class or the upper class. And so there is the Republicans have to begin to address the affordability, the growing sense of insecurity of people who work in this country who feel like they're not getting a fair shake. And you see it in New York, and you'll see it probably in California during this vote. But the left has to be more sophisticated in how they address these issues. And you can't just knee-jerk, the latest trend. It won't work.
But now Heidi mentions a number of ways to raise more taxes from wealthy people without resorting to this terrible California proposal. I would just point out, and I'm in favor of closing loopholes that broaden the base on which we apply lower rates. I think that's the right principle for a tax code. But, the top 1% of American earners earn roughly 20% of all the income and pay roughly 40% of all the income taxes. So the fact is, upper income people are already paying a disproportionately high share of the taxes. And I never hear from my Democratic friends who want to get more still. How high does that have to go in order to be fair? Do they have to pay 3 times their share of income, 4 times their share of income? There's a lot of taxes being paid by upper income people.
Yeah, and Pat, I never hear from you a combination of payroll taxes along with these taxes.
But as you know, payroll taxes are a very different category, Heidi.
You're talking about entitlement and entitlement reform.
Medicare.
Yeah,
that is the justification for considering that an earned benefit, because it is supposed to be funded primarily by payroll taxes. The rest of government is funded primarily by income taxes.
Very smart conversation from 2 very smart people who understand the tax code so well. We appreciate it. It's good to see both of you, and we'll have you back to talk about some real issues that might actually help. All of these things that you 2 are bringing up are perfect. Heidi, Pat, thank you both.
All right. Happy New Year.
You too.
Next up on Squawk Pod, a new year, new drinking habits? CEO and co-founder of Athletic Brewing, Bill Shufelt, joins us. He's riding the wave of non-alcoholic drinks.
We have brewed cocktails, the Paloma and the Moscow Mule, at select retailers like Target, Whole Foods, Wegmans, H-E-B across the country that are delicious. And surprisingly so, I didn't think they'd be in my wheelhouse.
You're listening to Squawk Pod.
The quiet after the storm that was New Year's Eve. There's still a lot of confetti that is rolling around. It's made its way into the building, into the parking garages, all over the place. Yeah, but here we are. Things are a little quieter today. You're watching Squawk Box right here on CNBC. I'm Becky Quick, along with Mike Santoli and Robert Frank. Joe and Andrew are off today.
A new year brings new resolutions, usually about health, like drinking less alcohol. Joining us now is the co-founder of a company that's been riding the sober, curious wave, Bill Shufelt, the CEO of Athletic Brewing. Bill, thank you so much for joining us. Great to have you. So what's the growth been like in the industry as a whole? And I know you guys have a huge share of non-alcoholic brews at 36%, something like that. What's driving the growth, and what does that growth look like in the year or 2 ahead?
Yeah, thank you so much for having me on. Huge fan of the show. I guess in the last 18 months since I was here last, we were talking about our growth round from General Atlantic, where we raised $50 million to accelerate our growth. And over that time, we've grown our trailing 12-month sales by about 53% into a historically bad alcoholic beer environment.
Yeah.
You see all the headlines where alcoholic beer tends to be down 3 to 6 to 10% across the board. Non-alcoholic beer continues to truck right through that as a very durable mega trend for a lot of reasons. On the athletic side, outside of that, we have grown our share in the category despite hundreds of entrants literally into the category. We're about an 18.4 share of the category overall, 52% share of non-alcoholic craft beer. So outselling all 150 plus non-alcoholic craft beers combined behind us. And then we took that growth capital and built another big brewery on the West Coast, which we just commissioned this past October of 2025, but that's one of the biggest West Coast breweries in the country.
And you mentioned there are a lot of reasons for that growth. I think what we've read a lot about is Gen Z just doesn't like to drink. Some of it has to do with they just don't socialize as much. Some of it has to do with the availability of marijuana and cannabis out there. What are you seeing as the big drivers for why people, are they switching, or is it just going from seltzer to non-alcoholic craft?
Yeah, I think so. I mean, just taking it to my story too. Like, I have a Whoop on one hand, Apple Watch on the other hand. I came from a finance background where I was in the seat at 6 a.m. for 12 years, and like I was go, go, go. Also fashioning myself as a husband and a father and a recreational athlete. Life these days, you have your work in your pocket 24/7. It leads to more moderation. I don't think it's that Gen Z hates alcohol, hates having fun. Everyone still wants all the experiences with their colleagues, their family. They want fine culinary experiences. The problem was that other side of the menu didn't exist previously, so there's really no option to be moderate and have those things. So what we did was we reinvented not only the taste and quality of non-alcoholic beer, but the branding and marketing of it, so you were proud to hold these drinks for the first time with the label out. And now we've seen those trends really take hold. Just to put some stats behind it, in a Gallup poll this past summer, over 53% of Americans perceive drinking 1 to 2 drinks a day as unhealthy, which is up, I think, 14 points in 2 years.
I was going to say, I think it's a status thing to actually show this is non-alcoholic. Rather than pour it in a glass, you're maybe showing off, I'm drinking, but I'm not.
Yeah, and 10 years ago, it was like impossible to order a discreet non-alcoholic beverage in a work setting or with friends. And so we really wanted to change that. And then also, it's a record low Americans are drinking alcohol on a weekly basis, which I think is 54%. And that's also down 8 points over that same 2-year period.
Now, I'm really into fitness. I don't drink, but I was looking at your nutrition label, and I was looking at the carbs in there, and obviously,
that's what I was going to ask. What's the calorie count?
Obviously, the calories aren't so bad compared to regular beer, but to make it taste good, it does seem like you have more carbs than regular beer. So, how do you see that as terms of your health proposition?
Yeah, well, honestly, we have something for everyone, really. On the low end of the spectrum, our Athletic Light Lager, which is an award-winning lager taste, is 25 calories, no sugar, and 5 carbs.
Okay, 5 carbs.
That is a guilt-free sipper any hour of the day. But the nice thing with non-alcoholic beer tends to be 20 to 30% of the calories of an alcohol equivalent style.
Right.
Because ethanol is so calorie dense. So our IPAs,
and a lot of sugar.
A lot of IPAs are 200 to 500 calories. So we've won 185 Global Taste Awards, 33 last year alone. And our IPAs, I would challenge anyone to be the best weeknight food pairing there is. And that's only 65 to 75 calories, which is pretty digestible for a real weekday treat.
And we've got to wrap it up, but I know you're expanding into what looks like mocktails or a whole other category. What's that about?
Yeah, I almost forgot to talk about January. This is like the Super Bowl for non-alcoholic drinks, introducing to new customers. We have a huge partnership with Open Table this month, and then more innovation than we've ever had launching this year. We have brewed cocktails, the Paloma and the Moscow Mule, at select retailers like Target, Whole Foods, Wegmans, H-E-B across the country that are delicious, and surprisingly so. I didn't think they'd be in my wheelhouse. And then this year, we have a lot of innovation building off our core lineup. Our Athletic Light Lime and Salt is really fun and guilt-free on the nutritionals. But then we launched over 50 beers on our website last year alone on athleticbrewing.com because we, unlike most brands in the category, we actually have built breweries, have our own brewing and quality teams. We've built 4 breweries now. And so we can just churn out the innovation and keep winning those awards.
Love it. Bill, thanks so much for joining us. Happy New Year.
Yeah, here's to dry January.
For sure. Yeah. Look forward to being back with more news before too long, hopefully.
And that is Squawk Pod for today. Thank you for listening to this first podcast of 2026. Squawk Box is hosted by Joe Kernan, Becky Quick, and Andrew Ross Sorkin. They will all be back next week. Please tune in on TV weekday mornings on CNBC at 6 Eastern, or get the smartest takes and analysis from our TV show right into your ears when you follow Squawk Pod wherever you get your podcasts. We'll meet you right back here on Monday. Have a great weekend.
We are clear. Thanks, guys.